Welcome to Iron Financial, the only place where we help you forge a stronger portfolio by cutting through market weakness. Today, we're putting Chipotle under the microscope. You see them everywhere, right? New locations popping up on every corner, those Chipotle drive-thrus are always buzzing. On the surface, this company looks like an unstoppable freight train, an absolute empire built on burritos.
And their latest earnings report seems to back that up with these huge headline-grabbing numbers that have everyone talking.
Exactly. But this is Iron Financial. We don't just look at the shiny exterior. We look for cracks in the foundation. What if all that explosive growth is actually just a smokescreen? Today, we are digging deep into the numbers to expose what we're calling Chipotle's growth paradox, a hidden structural weakness that could threaten the entire company. Let's get to work. All right, let's start with a big, heavy number that got Wall Street so excited. For the full year 2025, Chipotle hauled in a staggering $11.9 billion in total revenue.
Wow, okay. For a fast casual chain, that is a colossal figure. That's the kind of number that screams blue chip stock, a company that can do no wrong. It's hard to argue with nearly $12 billion.
And this is where the real analysis begins. This is where we earn our keep. We have to ask the tough question. Does that massive revenue number automatically mean this is a healthy business? Does it mean the foundation is solid steel?
Or is it possible that the bigger a company gets on the outside, the more it might be hiding some serious structural problems on the inside? That's the core question we need to answer today, isn't it? Is this real strength or just a facade?
To get to the bottom of it, let's first look at the story that Chipotle's management wants everyone to focus on. This is the narrative of its massive, undeniable expansion. This is the highlight reel. On paper, this part of the report looks like pure, unadulterated success. They are building an empire at a blistering pace. And you can't deny it. The expansion numbers are truly impressive. Forget the $11.9 billion in revenue for a second and just look at the physical footprint. It's exploding. They hammered open 334 new company-owned restaurants in just 1 year. That pushed their total store count over the 4,000 mark.
But the real story here, the thing that jumps out at me, is how they're expanding. Look at the focus on Chipotlanes. 257 of the new builds have a drive-thru. That's not an accident. That is a clear strategic pivot. They're chasing maximum convenience and trying to capture that on-the-go customer who doesn't even want to get out of their car.
Of course, and leadership is framing this whole thing as a massive victory. The CEO, Scott Boatwright, came out and celebrated a year of progress and resilience, crediting their aggressive expansion model.
So the official story they're selling is simple. More stores means more money, which means more success. End of story. But if you're a serious analyst and you stop reading the report right there, you are missing the most critical piece of the puzzle. You're missing the weakness.
Exactly. Because when we look past all the ribbon cuttings and grand openings at these brand new locations, we find a major glaring contradiction. It's what we call a tale of two numbers.
And this is where the facade starts to crack. This is the story that reveals what's actually happening inside the Chipotle stores that have been around for years. The ones that are supposed to be the bedrock of the company.
Okay, on one side of the coin, you have this number, a positive 5.4% growth in total revenue for the year. And look, that makes perfect sense. It's simple math. When you open hundreds of new stores, of course your total sales are going to climb. This is growth by brute force expansion. But then you see this. And this number should stop you dead in your tracks. Full year comparable restaurant sales, and we're going to break that down in a second, actually went down by 1.7%. And that right there is the entire growth paradox in a nutshell. The Chipotle empire is getting wider, it's spreading across the map, but its older foundational stores, the core of the business, are actually bringing in less money than they did the year before. That is a serious problem. And this isn't some problem that's getting better over time. In fact, it looks like it's getting worse. If we zoom in and isolate just the last 3 months of the year, Q4, that gap actually widens. Total revenue was still up, but the comparable sales fell even faster, dropping by a pretty scary 2.5%.
That suggests this negative trend is accelerating, which is a massive red flag for any serious investor or analyst. So this brings us to the most important point of this entire breakdown. What exactly is this metric that's causing so much concern? We have to understand.
Okay, to really understand the structural integrity of this company, we need to crack the code on the single most important metric for any restaurant or retail chain, comparable sales. You'll often hear it called comp sales or same-store sales. It's the whole ball game. Now, the official definition from the financial report, as always, sounds a little dense and academic. It's the sales change for restaurants that have been open for at least 13 full months.
And there's a very specific reason for that 13-month rule. It's designed to ignore the initial hype and the inflated sales numbers of a brand new store. It creates a true apples-to-apples comparison of a store's performance against itself from the prior year. It's about measuring fundamental health.
Let's just put it in plain English. This metric answers one simple, crucial question. Are your core established stores healthy? Are they growing on their own organically, or are they shrinking?
It completely strips away the illusion of growth that just comes from opening more and more locations. A negative number here means that, on average, your existing restaurants are bringing in less money than they did the year before. And that is a foundational problem. It's a sign of decay.
So where is this weakness actually coming from? The report breaks it down for us, and it's illuminating. If you look at this chart, you can see two opposing forces at work. The average check, that's how much each person spends per visit, is actually up 1.2%. That's mostly thanks to them raising menu prices.
But that small gain from higher prices is completely wiped out. It's overwhelmed by the much larger drop in transactions, which are down almost 3%. So the problem isn't what people are buying, it's that fewer people are showing up to buy anything at all. The foot traffic is drying up.
Now, when sales at your existing stores go down like this, it creates a nasty ripple effect that puts some serious pressure on your profitability. It's like a vice grip on your margins. Let's look at how this squeeze is affecting Chipotle's bottom line, because this is where the weakness really starts to hurt. This table really tells the whole story of that pressure cooker. Just look at the key costs as a percentage of revenue. Food costs are pretty flat, which is good. But look at labor. It's creeping up. And the real jump is in what they call other operating costs. We're talking about things like rent, utilities, maintenance, the fixed costs of keeping the lights on.
And when sales per store are down, all of those fixed costs take a bigger and bigger bite out of every single dollar that you make. Your operational efficiency is dropping, and your profit margins are getting squeezed from both sides. It's a classic margin compression scenario.
And here it is, the direct result of all that pressure. The restaurant-level operating margin, which is a crucial measure of how profitable each individual restaurant is on its own, fell. It dropped from 26.7% down to 25.4% in 1 year. So let's be crystal clear about what this means. Not only are the established stores selling less food, but they are also becoming less profitable on the sales they do manage to make. This is the real danger of the growth paradox. The foundation is weakening while they're still trying to build the skyscraper higher. Okay, so to be fair, Chipotle's leadership is clearly aware of this problem. They see the numbers, they're not just sitting back and hoping it goes away. In response, they've launched a big new strategy they're calling their Recipe for Growth.
And it's designed specifically to address these challenges head-on. The entire goal is to stop the bleeding in the existing stores and figure out how to get those customers back in the door. This is their comeback plan.
All right, here's their 5-point counterattack. It's a mix of back-to-basic stuff like improving store operations and food quality and more forward-looking initiatives. They're talking about menu innovation, better marketing, and modernizing the business with tech like AI and a totally new rewards program.
It's a comprehensive strategy, at least on paper. It hits all the right corporate buzzwords. The billion-dollar question, though, is whether they can actually execute on this plan effectively enough to solve the core problem, which is fewer people are walking into their established restaurants. Can a PowerPoint presentation fix that?
So what does the company expect for the year ahead? Their official guidance is very, very telling. For comparable sales, that all-important metric, they anticipate it will be about flat. Now, what that signals to me is they hope to stop the bleeding, but they aren't confident enough yet to promise a return to strong organic growth at their existing stores.
Meanwhile, the expansion engine is not slowing down one bit. It's full steam ahead. They plan to open even more restaurants in 2026, maybe up to 370, with a continued heavy emphasis on that Chipotle drive-thru model. They are doubling down on what they know, which is building new stores.
So this brings us to the final critical question, the verdict. Chipotle is doubling down on its expansion strategy, betting that it can build new stores fast enough to outrun the weakness in its old ones. It's a race.
But can a 5-point plan, some AI, and a new rewards program really be enough to reverse this negative trend? Will this new recipe actually bring customers back?
The answer to that question will determine whether Chipotle is building a lasting, durable empire or just a beautiful facade that's crumbling from within. For us at Iron Financial, this is a clear sign of weakness. We see a company masking a core problem with aggressive expansion. Until they can prove that their foundation is solid again, this is one to watch from the sidelines. That's the story to watch.